Hey everyone, my name's Bhavik. I'm going to be going over the investments tutorials with you this semester. So, this is tutorial 1 based on chapter 1 and 2. Let's start with the written section. So, for each of the following securities, define the asset class under which they would fall and comment briefly on the risk return characteristics you would expect them to possess. So part A, a share in BHP Billiton. So this is a mining company. You can actually find out more information on these companies. Just do a quick Google search on them. So BHP Billiton, it's in the basic material sector. It's got a high beta, approximately 1.5. So high beta means high risk. Um, Higher expected volatility and return to compensate, for the higher risk. Resources and mining sector, hence highly exposed to fluctuations in commodity prices. The next is SAB, South African Breweries. It's in the consumer goods sector, and it was acquired by AB InBev in 2016. So you could look at AB InBev to get more information on SAB. So it's got a low PE ratio and a stable dividend yield. It's a mature company with stable revenues and it's a relatively safe for stock investments, so can be considered as a value stock. So the definition of a value stock, it basically refers to shares of a company that appear to trade at a lower price relative to its fundamentals, such as dividends, earnings, or sales, making it appealing to value investors. The next is Facebook, which is also known as Meta. So this is in the technology sector. It's got a high PE ratio, high growth opportunities, and it doesn't issue dividends yet. You can think of Apple. Apple recently started paying dividends. I think it's probably one of the first in the tech sector to do so because it's so large and they've got so much cash flow. Um, so that's Apple. Then back to Meta, it can be considered a growth stock, and that's why it's relatively risky. Standard Bank, it's in the financial services sector. It's one of the big four banks in South Africa. It's got a low PE ratio, major market share. It's a safe investment as it has low volatility. Part B, we're going to look at the following bonds: a 6-month US Treasury bond. It's a money market instrument. Money market instruments normally have short-term investment maturity, so you can think of less than a year. And it can be considered risk-free because it's issued by the US government. Next, we've got SA Government R157. So it's medium term, approximately 3-year investment. And it can also be considered as a risk-free because it's issued by the government. Then we've got Bloomberg US Corporate Bond Index. If you click on the link, unfortunately it doesn't work anymore. I think you would need access to the Bloomberg terminal to see this particular bond index. But anyway, it's a fixed interest asset that are more risky than government bonds. Remember, corporate bonds are always more riskier than government bonds, and they are less risky than stock. So the corporate bond index represents bonds issued by major American corporates, and it offers higher returns than government bonds, but less than stock. Convertible bond in ShopRite. So we've got a fixed interest income that has the same risk as a corporate bond. It can be converted into common stock or shares at maturity at a fixed price, hence a premium is most likely to be charged. So with a convertible bond, basically you have this option to convert the bond amount or the principal amount into shares So instead of receiving the principal amount back, you would receive shares in the company. Remember, this is an option, so you don't have to follow through with it if you don't want the shares. Okay, moving on. We've got a 3-month NCD held with RMB. An NCD is a negotiable certificate of deposit. It's a very safe investment due to its short-term nature, and it's usually got low returns. Question 2, we've got a 5-year California municipal bond which trades at a yield of 3.2%. If an investor faces a tax rate of 25%, what should the equivalent yield be on a 5-year US Treasury bond, assuming similar risk across these securities? So, assuming that no taxes on the 5-year US Treasury bond, an investor can expect an equivalent yield of 2.4%, which equates to the net return gained on the California municipal bond. So I've got the formula 1 minus TC times the yield of the municipal bond, which should equal to the yield of the US Treasury bond. So just plug in the numbers. So 1 minus 25% times your 3.2% is, and that's how you get your answer of 2.4%. Remember, the return on municipal bonds, you don't have to pay taxes on them. So that's where this whole formula comes from. Question 3, assume we have put together an investment portfolio split 70-30 between equities and bonds. So 70% of our portfolio goes to equities and 30% goes to bonds. If we allocate 2.5% of the equity portfolio into shares in Steinhoff and 40% of the bond portfolio into SA government R186 bonds, what proportion does each security make up in the overall portfolio? So Steinhoff, that's an equity, so it'll be 0.7 times our 2.5%, and that's how we get the 1.75% of our portfolio, which is invested in Steinhoff. Then for the R186 bonds, it's a bond, so it'll be 0.3 times the 40%, and that's how we get 12% of our overall portfolio, which is invested in these R186 bonds. Moving on to the multiple choice questions. Active trading in markets and competition among security analysts helps ensure that blank. Number 1, security prices approach informational efficiency. That's true. Riskier securities are priced to offer higher potential returns. That is also true. Number 3, investors are unlikely to be able to consistently find under or overvalued securities. That is also true. So it looks like D is the answer. Question 2, which of the following is not a money market security? So remember, with money markets, we said it's got a maturity of less than a year. So US Treasury bill, that is a money market security. 6-month maturity certificate of deposit, that is also. Common stock, that's not a money market security, that is equity. Yeah, banker's acceptance, that's a money market security. So yeah, the answer is C. Question 3, which of the following are financial assets? So debt securities, equity securities, derivative securities, all 3 of them are financial assets. So D is our answer. Asset allocation refers to the allocation of the investment portfolio across broad asset classes. That is asset allocation. But let's go through the other answers. So B says the analysis of the value of securities. No. C says the choice of specific assets within each asset class. No, that sounds like security selection. And D says none of the above. So our answer is A. Question 5, security selection refers to, well, we know it's not A, the allocation of the investment portfolio across broad asset classes, because we said that's asset allocation. Is it B, the analysis of the value of securities? No. Choice of specific securities within each asset class? Yes, that is our answer. Is it D, top-down method of investing? No. So yeah, C is the answer. Question 6. So a blank represents an ownership share in the corporation. Call option, no, that's a derivative. A common stock, it is, yes, that does represent share ownership in our corporation. Fixed income security, no. Preferred stock, it's a type of share ownership in a corporation, but yeah, the exact answer is B. Question 7. Something portfolio management calls for holding diversified portfolios without spending effort or resources attempting to improve investment performance through security analysis. So active, no. Momentum, no. Passive, that's our answer. Market timing, I don't know what that is. But yeah, the answer is passive because you're not spending any effort or resources trying to improve your investment performance. It's basically just placing your money in some index and just doing nothing about it. Yeah, so that's question 7. Question 8. Financial markets allow for all but which one of the following? So shift consumption through times from higher income periods to lower. Yes, we can do that. I can take my money, I can invest it now, and a year later, hopefully I should have more money, which I can use later. Yeah. B says price securities according to their riskiness. So yeah, markets do that. Riskier securities will obviously be priced higher. Then we've got C, channel funds from lenders of funds to borrowers of funds. Yes, financial markets do that. D, allow most participants to routinely earn higher returns with low risk. No. So that's our answer. Allow most participants to routinely earn high returns with low risk. So according to finance theory, that's not true. Question 9. Financial intermediaries exist because small investors cannot efficiently diversify their portfolios. So yeah, to diversify your portfolio, it would be quite difficult. It would be expensive for you because you don't have the funds to do that as a small investor. It's also difficult for you to gather information. Because yeah, the databases like Bloomberg, they all cost money. Monitoring your portfolio is also difficult for a small investor. And D says all of the above answers provide reasons why. So yeah, D is our answer. Firms that specialize in helping companies raise capital by selling securities to the public are called A, pension funds. So no, pension funds, they basically invest people's retirement money for them. B, investment banks. So that is the answer. We know what investment banks do. C is the savings banks. No. D is real estate investment trusts. So those are the companies that invest in real estate, and they often give a return every month. So question 11, securitization refers to the creation of new securities by selling individual cash flows of security or loan. No. Repackaging individual cash flows of a security or loan into a new payment pattern. No. That doesn't really have anything to do with payment patterns. C is taking a liquid asset, converting it into a marketable security. That is actually our answer. D is selling financial services overseas as well as in the US. No, that is definitely not it. Question 12, a dollar-denominated deposit at a London bank is called Eurodollars, LIBOR, Fed's rate, banker's acceptance. So the answer is actually A. You can go and research the other answers and just see what they are. Question 13, an investor in a T-bill earns interest by receiving interest payments every 90 days. So T-bills don't actually pay out interest. So that's not the answer. Receiving dividends payments every 30 days, they don't pay out dividends. So converting the T-bill at maturity into a higher value T-note, no. Buying the bill at a discount from the face value received at maturity. That is our answer. So if the face value is 1,000, and this bill it should be trading at a discount before maturity. So if you buy it at the discount and then you sell it at maturity, that's basically how you earn money through investing in T-bills. Number 14, which of the following is not a characteristic of a money market instrument? Liquidity, that is a characteristic because the money market instruments are normally tradable. Marketability, yes. Low risk, they do have low risk. Maturity greater than 1 year, that is definitely the answer. Remember, money market instruments have a maturity of 1 year or less. So commercial paper is a short-term security issued by someone to raise funds. So it's not the Federal Reserve, that's like the Central Bank of America. It's not commercial banks. It would be, and it's not the New York Stock Exchange. It's definitely C. Commercial paper is issued by companies, large well-known companies. Question 16. Treasury bills are financial instruments issued by blank to raise funds. Commercial banks, the federal government, large corporations, state and city governments. So the answer is actually the federal government. Question 17. The interest rate charged by large banks in London to lend among themselves is called, it's not the prime rate, it's not the discount rate, it's not the federal funds rate, it's LIBOR. Yeah, LIBOR is the rate which banks in London use to basically lend money amongst themselves. So that was 17. Question 18. Which of the following provides the best example of securitization? So securitization, you can think of basically taking assets, pooling them together into some investable security. Yeah, so it's not a convertible bond, it's not a call option, and it's not preferred stock. The answer is C, mortgage pass-through security. Yeah, so that's tutorial 1. I hope you managed with the questions. And yeah, I guess I'll see you in tutorial 2. Thanks for listening.